Ladies and gentlemen, let me ask you a simple question before we begin. When the price you see no longer matches the price you pay, what does that tell you about the system you're living in? Right now, the paper price of silver flashes around $30 on your screen, calm, controlled, familiar. But on the ground in China, the price of physical silver is pushing $80. Not in theory, not in forecasts, in reality. And whenever reality and paper diverge this violently, history tells us one thing very clearly: a break is coming. We are standing at the edge of a moment most people won't recognize until it's already passed. This is not just about silver. This is about trust, scarcity, and the silent unraveling of a system built on promises instead of substance. The gap between paper and physical is no longer a crack, it's a canyon, and it's growing wider every single day. For decades, paper markets have told the world what silver is worth. Futures contracts, ETFs, derivatives, layers upon layers of claims stacked on top of a finite metal, pulled from the ground with sweat, energy, and time. Paper silver can be created instantly with a keystroke. Physical silver cannot. It must be mined, refined, transported, and secured. That difference has always existed, but today it is finally being priced in by those who understand what's coming next. In China, silver is not treated as a speculative toy. It is treated as an industrial necessity and a strategic resource. Solar panels, electronics, medical equipment, defense technologies. Silver sits at the heart of modern civilization. When supply tightens, industry doesn't argue with paper charts. It pays whatever price is required to secure metal. That is why physical premiums are exploding. That is why $80 silver is already here, even while the paper market pretends nothing is wrong. And here's the hook: most people miss paper prices only work as long as physical delivery doesn't matter. The moment too many people demand the real thing, the illusion collapses. You cannot settle a factory supply chain with a futures contract. You cannot build solar infrastructure with an ETF share. At some point, the world stops asking, "What is the price?" and starts asking, "Do you even have it?" This is exactly how every major commodity repricing begins. First, insiders quietly accumulate. Then premiums rise in places most people aren't watching. Then delivery delays become normal. Then confidence cracks. And finally, the paper price snaps upward, not gradually, not politely, but violently, to catch up with reality. The 30 price is not stability. It is suppression under strain. Think about what $80 silver in China is really signaling. It is telling you that supply is tighter than reported. It is telling you that demand is stronger than admitted. And most importantly, it is telling you that the global price discovery mechanism is failing. When the largest manufacturing economy on Earth is paying more than double the quoted price is no longer truth, it's denial. This moment rewards clarity, not comfort. Comfort says, "It's always been this way." Clarity says, "This time, the math doesn't work." There is not enough silver above ground to satisfy industrial demand, investment demand, and strategic stockpiling at these prices. Something has to give. Either demand collapses, which history shows it won't, or price resets upward to ration supply. And here is where the motivational truth comes in. Wealth is not built by following headlines, it's built by understanding signals before they become headlines. By the time mainstream media talks about a silver shortage, the opportunity will already be gone. By the time paper prices reflect physical reality, the revaluation will already be complete. The widening gap between the 30-year paper price and 80 physical silver in China signals a breakdown in price discovery. Futures markets reflect leveraged claims, not real availability, while physical markets price immediate supply constraints. Historically, sustained decoupling indicates structural stress rather than temporary volatility. Industrial demand is setting the marginal price. Silver's price floor is increasingly determined by industrial buyers, not speculators. Solar energy, electronics, and advanced manufacturing require guaranteed delivery, forcing buyers to pay premiums. When industrial demand dominates, price elasticity decreases and spot benchmarks lose relevance. Supply inelasticity and depletion risk. Silver mining supply is highly inelastic in the short and medium term. New production requires years of capital investment, permitting, and development. At the same time, above ground inventories are declining, increasing vulnerability to demand shocks and accelerating price repricing. Leverage and counterparty risk in paper markets. Paper silver markets are built on extreme leverage, with multiple claims per ounce of deliverable metal. As delivery requests rise, counterparty risk increases, raising the probability of cash settlement or force majeure events. both of which undermine confidence in paper pricing. Geographic arbitrage failure. The persistence of an $80 in physical price in China indicates that global arbitrage mechanisms are no longer functioning efficiently. Trade restrictions, logistics costs, strategic stockpiling, and export controls are preventing price convergence, fragmenting the global silver market. Inevitable price reconciliation mechanism. Economic theory suggests that prolonged price divergence resolves through upward repricing of the constrained asset rather than downward convergence of physical premiums. In commodity markets, scarcity is ultimately rationed by price, making a sharp adjustment in benchmark silver prices the most probable outcome. The growing separation between paper silver prices and physical silver prices is not a minor market anomaly. It is a signal that the core mechanism of price discovery is under strain. When paper silver trades near $30, while physical silver in China clears near $80, the market is no longer communicating value, it is revealing imbalance. Paper prices are shaped by futures contracts, high-frequency trading, and leveraged speculation, all of which can multiply supply on screens without increasing a single ounce in vaults. Physical prices, by contrast, reflect urgency, availability, and the real cost of securing metal today. When these two prices diverge sharply and persistently, it tells us that one market is dealing in abstractions while the other is confronting reality. Here's the hook most investors misprice: only matters when delivery matters. Futures markets were designed for hedging and risk transfer, not as permanent substitutes for physical exchange. Over time, excessive leverage transforms these markets into price smoothing machines, suppressing volatility and masking shortages. But leverage has a weakness. It relies on confidence that claims can be settled. The moment participants begin to question whether paper claims can reliably convert into metal, paper prices lose authority. What we are witnessing now is that exact loss of authority quietly unfolding. Economic history is filled with moments like this. Whenever a commodity's financial representation grows detached from its physical base, the divergence widens before it resolves violently. Oil in the 1970s, nickel in recent years, and even gold at various points followed the same pattern. First, physical users pay premiums. Then regional prices disconnect. Then delivery timelines stretch. Finally, the paper benchmark reprices abruptly to regain credibility. The silver market is now deep into the early and middle stages of that cycle. China's physical pricing is especially revealing because it is driven by necessity, not speculation. Industrial buyers cannot hedge shortages with spreadsheets. They respond to scarcity by paying up, locking supply, and absorbing higher costs to protect production. That behavior embeds real economic information into physical prices, information paper markets are currently ignoring. When a manufacturing economy values immediate possession at more than double the quoted global price, it is effectively voting against the paper benchmark. This is not an argument about manipulation in a sensational sense, it is about structural incentives. Paper markets reward liquidity and leverage, while physical markets reward certainty and possession. As long as confidence holds, the system functions. When confidence erodes, divergence accelerates. The widening gap is not noise, it is the market's early warning system flashing red. Those who understand this don't wait for official confirmation. They recognize that when paper and physical part ways, the paper price is not a ceiling, it's a placeholder waiting to be replaced. The most important shift happening in the silver market today is not being driven by traders or chart patterns, but by factories, utilities, and supply chain managers who cannot afford shortages. Industrial demand has quietly become the marginal price setter, and that changes everything. Unlike speculative demand, which is highly sensitive to price movements, industrial demand is price inelastic. When silver is essential to production, buyers do not walk away because the price doubles, they pay more to keep operations running. This is why physical silver is commanding extreme premiums in key manufacturing regions, while paper prices remain artificially calm. Here's the hook that challenges conventional thinking: markets don't move when investors get excited, they move when industry gets desperate. Silver is no longer just a monetary metal or a hedge. It is a critical input for solar panels, electric vehicles, semiconductors, medical devices, and defense technologies. Each of these sectors is expanding simultaneously, and each relies on silver for its unique conductivity and durability. There is no scalable substitute that can be deployed quickly without sacrificing performance or efficiency. That lack of substitution power gives industrial buyers pricing authority that speculators simply do not have. When industrial users step in as the buyers of last resort, the pricing structure changes from optional to compulsory. A trader can exit a position. A manufacturer cannot exit a supply chain. If a solar producer fails to secure silver, it doesn't just miss profits, it misses deliveries, contracts, and market share. That risk dwarfs incremental price increases. As a result, industrial buyers begin bidding against each other, locking in long-term contracts, and accepting higher spot prices to guarantee availability. Those actions inject upward pressure that paper markets struggle to reflect until the imbalance becomes impossible to ignore. Another critical dynamic is timing. Industrial demand is forward, looking in a physical sense, not a financial one. Factories secure metal months or years ahead of production, pulling future supply into the present. This front-loading of demand tightens availability faster than mining output can respond. Paper markets, however, discount future scarcity because they assume smooth supply responses. That assumption fails when production cycles stretch over years and inventories are already thin. The result is a growing contradiction. Paper prices signal abundance, while physical transactions signal constraint. That contradiction cannot persist indefinitely. The marginal price, the price at which the last ounce is sold, will always be set by the buyer who needs the metal most urgently. Today, that buyer is industry, not the trading desk. When industrial demand sets the floor, prices do not fall back to comfort levels. They ratchet higher until demand is rationed. This is why ignoring industrial pressure is not conservative, it is dangerous. One of the most underestimated forces in the silver market is how little flexibility exists on the supply side. Silver production cannot respond quickly to rising demand, no matter how high prices go in the short term. Mining is a capital-intensive, time-consuming process shaped by geology, regulation, and energy costs. New discoveries are rarer, ore grades are declining, and the majority of silver is produced as a byproduct of other metals like copper, lead, and zinc. That means silver supply is not even primarily driven by silver prices, creating a structural bottleneck that markets consistently misprice. Here's the hook that changes how you see scarcity. Higher prices do not automatically mean more silver. Unlike manufactured goods, silver cannot be scaled on demand. Even if prices surge overnight, it can take a decade or more to explore, permit, finance, and develop a new mine. Existing operations cannot simply double output without significant investment and time. This lag creates a dangerous illusion in paper markets that supply will respond soon, when in reality the response may arrive long after the shortage has already reshaped pricing. At the same time, above-ground inventories are shrinking. Silver is not like gold, where nearly all mined metal remains accessible in vaults or jewelry. A large portion of silver is consumed irreversibly in industrial applications, dispersed in tiny quantities across electronics, solar panels, and medical devices. Once used, much of it is uneconomic to recover. This steady attrition means that each year's production must cover both new demand and the permanent loss of previously mined silver, tightening the balance even further. Supply constraints are compounded by rising production costs. Energy, labor, environmental compliance, and geopolitical risk have all increased the cost curve for miners. Many projects that look viable on paper remain uneconomic in practice, especially in jurisdictions with unstable regulations or currency risk. As costs rise, marginal producers shut down rather than expand, further reducing available supply at precisely the moment demand is accelerating. The critical contradiction is that global silver pricing still assumes elasticity that does not exist. Models built on historical abundance fail when inventories approach depletion thresholds. When stockpiles fall below operational minimums, the market doesn't adjust gradually, it reacts abruptly. Buyers move from optimizing costs to securing survival, and price becomes secondary to availability. This is why silver shortages do not announce themselves politely. They build quietly beneath the surface, masked by paper liquidity, until physical supply reaches a breaking point. When that happens, the revaluation is not driven by optimism or speculation, but by necessity. Scarcity doesn't negotiate, and markets that ignore inelastic supply eventually learn that lesson the hard way. The modern paper-silver market is built on leverage so extreme that it only functions as long as participants believe they will never need the metal itself. Futures contracts, unallocated accounts, and exchange-traded products create multiple claims on the same ounce, multiplying apparent supply without adding physical inventory. This structure works smoothly in calm conditions, but it becomes fragile the moment delivery expectations rise. The risk is not theoretical, It is embedded in the system's design. When too many holders ask the same question at the same time, can I have the silver? The answer becomes uncertain. Here's the hook most people overlook. Counterparty risk doesn't matter until suddenly it's all that matters. Paper contracts are promises, and every promise is only as strong as the balance sheet behind it. In highly leveraged commodity markets, settlement is often assumed rather than tested. The vast majority of contracts are rolled over or cash settled, creating the illusion that physical backing is irrelevant. But that assumption collapses the moment confidence wavers. If even a small percentage of participants demand delivery, the leverage ratio turns from efficiency into exposure. As delivery pressure increases, exchanges and intermediaries face difficult choices. They can raise margin requirements, delay delivery timelines, or incentivize cash settlement. Each of these actions signals stress and undermines trust. Rational actors respond by demanding even more certainty, accelerating the very run the system is trying to avoid. This feedback loop is well documented in financial history, from bank runs to commodity squeezes, and silver is structurally vulnerable to the same dynamics. The distinction between cash settlement and physical settlement becomes critical in this environment. Cash can always be created, silver cannot. When markets substitute cash for metal, they preserve nominal stability at the cost of credibility. Industrial users and long-term holders understand this difference intuitively. They do not hedge production schedules or strategic reserves with cash promises when physical inputs are at risk. As a result, metal flows away from paper, back pools and toward direct ownership, tightening supply further. Another overlooked factor is jurisdictional risk. Many paper claims rely on centralized clearinghouses and regulatory frameworks that prioritize market stability over individual delivery rights. In a stress event, rules can change overnight. Force majeure clauses, emergency measures, and settlement adjustments are legal tools, not conspiracies. Their existence means that paper holders bear risks they rarely price in during normal conditions. The real danger is complacency. Leverage masks scarcity until it no longer can. When confidence breaks, repricing is not gradual, it is discontinuous. Those holding paper discover that liquidity was conditional, while those holding metal discover that possession was the only hedge that mattered. One of the clearest signals of stress in the global silver market is the breakdown of geographic arbitrage, a mechanism that normally keeps prices aligned across regions. In efficient markets, a significant price gap between countries should trigger metal flows from lower-priced regions to higher-priced ones, quickly narrowing the difference. When that mechanism fails, it is not due to ignorance or inefficiency, it is due to constraint. The persistence of sharply higher physical prices in China indicates that silver cannot move freely enough to restore balance, and that alone should command serious attention. Here's the hook that reframes the issue. If arbitrage isn't closing the gap, it's because the metal isn't there. Transportation costs, tariffs, and logistics frictions exist in every commodity market, yet they rarely justify a sustained price differential of this magnitude. What we are seeing instead is a combination of tight inventories, strategic stockpiling, and policy-driven barriers that prevent silver from flowing where it is most urgently needed. When a manufacturing powerhouse is willing to pay a dramatic premium rather than rely on global markets, it is revealing a lack of confidence in external supply. Another factor weakening arbitrage is time. Physical silver does not move instantly. Shipping delays, refinery bottlenecks, and financing constraints introduce lags that paper markets simply ignore. When demand is immediate, waiting weeks or months for delivery is not an option. Buyers pay premiums for proximity and certainty, and those premiums become embedded in regional prices. Over time, this creates semi-isolated markets where local supply and demand dominate global benchmarks. Strategic behavior also plays a role. Governments and large industrial players do not operate like traders seeking short-term profit. They prioritize resilience over efficiency, often accepting higher costs to reduce exposure to external shocks. By locking up domestic supply or favoring long-term contracts, they reduce the amount of metal available for international trade. This hoarding effect further weakens arbitrage and amplifies regional price divergence. Currency dynamics add another layer. When buyers expect currency depreciation or financial instability, holding physical commodities becomes a monetary decision as well as an industrial one. Paying a higher nominal price for silver can be rational if it secures a real asset against future uncertainty. Paper prices denominated in global currencies fail to capture this localized risk perception, widening the gap even further. The critical insight is that arbitrage failure is not a temporary glitch. It is a sign that the global silver market is fragmenting. Once markets fragment, price convergence no longer happens smoothly. Instead, each region reprices based on its own constraints, and global benchmarks lose their authority ounce by ounce. When a price divergence persists for long enough, economic theory leaves very little ambiguity about how it resolves. In commodity markets constrained by physical scarcity, reconciliation does not occur by premiums collapsing to match paper prices. It occurs by benchmarks rising to meet reality. The idea that physical prices will simply fall back in line assumes surplus, flexibility, and trust, conditions that are visibly eroding in the silver market. What remains is the most basic mechanism of all price must ration what supply cannot. Here's the hook that cuts through the noise. Markets do not argue with shortages, they surrender to them. As inventories thin and delivery risk increases, buyers shift behavior. Instead of optimizing for cost, they optimize for certainty. That behavioral shift is the catalyst for rapid repricing. It happens quietly at first through long-term contracts, off-exchange transactions, and strategic stockpiles. But once it reaches a threshold, the visible price adjusts in a compressed time frame. Paper benchmarks are especially vulnerable in this process because they rely on confidence rather than possession. As long as participants believe settlement will be smooth, prices can remain detached from physical conditions. But once doubt enters, once delivery delays, cash settlement incentives, or exchange interventions become routine, the benchmark loses its signaling power. At that point, it must either reprice upward or be abandoned in favor of alternative reference prices grounded in physical trade. Economic history shows that this transition is rarely linear. Prices tend to gap, overshoot, and reset expectations all at once. That volatility is not a sign of dysfunction. It is the market rapidly incorporating information that was previously suppressed. In silver's case, years of underinvestment, inventory drawdowns, and rising industrial dependence represent a backlog of unpriced risk. When that risk finally enters the price, the adjustment reflects cumulative pressure, not incremental change. Another critical factor is reflexivity. Rising prices change behavior in ways that reinforce the trend. Higher silver prices discourage discretionary selling, incentivize hoarding, and increase the perceived value of possession. At the same time, they strain users who must secure supply regardless of cost, pushing bids higher still. This feedback loop accelerates reconciliation and shortens the window for orderly adjustment. The assumption that benchmarks control markets is backwards. Benchmarks follow flows, and flows follow necessity. When enough participants act on physical constraints rather than paper signals, the benchmark has no choice but to catch up. The longer the delay, the sharper the move. Repricing is not a forecast, it is a function of arithmetic. Finite supply meeting non-negotiable demand can only resolve one way. So, as we close, remember this: markets don't break loudly at first. They whisper. They send signals through premiums, shortages, and quiet price discrepancies across borders. $80 physical silver in China is not a rumor. It is a warning that the paper game is reaching its limits and that reality is preparing to reassert itself. The break that's coming will shock those who trusted numbers on a screen, but it will reward those who understood the difference between promises and possession. History never changes its lesson, only the names and the numbers. When paper and physical part ways, physical always wins.